Good morning, friends! Today we're diving into a pattern that has helped traders across various financial markets time and time again, but in our expertise, it shines the brightest in crypto trading. We'll break down the candlestick pattern HAMMER, how it works and how you can use it in your trades. This pattern is super popular among technical analysts, so if you're eager to learn how to read charts properly and spot key entry and exit points, this video is for you. Let's get started. The hammer candlestick pattern is one of the most widely used tools for predicting potential trend reversals. So what does it look like? Picture a candlestick with a small body near the top and a long lower shadow extending below it at least twice the length of the body. That long shadow tells us that sellers drove the price down during the session, but buyers stepped in and pushed it back up, closing above the opening price. This reversal in momentum is the key insight traders use. There are actually 4 variations of this pattern. Let's go through them quickly. Bullish hammer. This pattern appears at the end of a downtrend and signals a potential reversal upward. The small body at the top shows buyers regain control, and the long lower shadow confirms their strength. Inverted hammer. Another bullish pattern, but less obvious. It forms when the closing price is higher than the opening price with a long upper shadow. It shows buyers tried to push the price higher but couldn't fully sustain it. Still, it can indicate a potential reversal after a downtrend. Hanging man. This bearish version of the hammer forms after an uptrend. The long lower shadow shows sellers dominated the session even though buyers tried to recover. The session closes lower, signaling a possible downward trend. Shooting star. Similar to the inverted hammer but bearish, appearing after an uptrend. The long upper shadow indicates a failed attempt by buyers to push the price higher, suggesting a potential downward reversal. Let's take a look at some real examples. Here's a bullish hammer on the USDT Bitcoin chart. See how the closing price is higher than the opening price, with buyers taking control and signaling a trend reversal. After this candlestick, the price began to rise, and it was a classic move that confirmed the bull's strength. Now check out this bearish hanging man. The long lower shadow shows sellers tried to push the price down, but buyers partially recovered. However, the overall signal here is bearish and the price corrected downward shortly after. Seems straightforward, right? Well, there are a few things you need to keep in mind. Context matters. The hammer must appear after a clear trend. A bullish hammer usually signals a reversal after a downtrend, while a bearish one appears after an uptrend. Use confirmation. Combine the hammer with other technical indicators. For example, if it shows up near support or resistance levels, or if other patterns confirm it, your odds of a successful trade increase. Don't confuse it with the doji. Many traders mix up the hammer and the doji. The hammer has a body and a long shadow, while the doji has no body. The open and close prices are almost equal. The doji signals market indecision, while the hammer is a stronger signal of a reversal. It's also worth following the basic rules for a more accurate definition of the hammer. The lower shadow should be at least 2 times larger than the body. The upper shadow should be small, or better yet, absent altogether. The color of the candle's body does not matter, although the red body has a stronger bearish undertone. The next candle should confirm the signal. With a bullish hammer, the next candle should have a red body, and with a bearish one, a green one. With an inverted hammer, the situation is mirrored and all logic is preserved. And yet, many traders are confused between the hammer and another well-known pattern, doji. By the way, we also have videos about it, be sure to watch them to compare. If the hammer has a body and a long shadow, then the doji has no body and the opening price is almost equal to the closing price. Doji usually signals market consolidation, while hammer is a clear signal of a possible reversal. The difference in these patterns is important for the correct interpretation of the charts. As Warren Buffett says, Success doesn't depend on IQ, degrees, or your profession. Anyone can earn money if they're willing to learn. Trading isn't just about analyzing charts, it's also about managing your risks effectively. If you found this video helpful, smash the like button and subscribe to the channel. Stay tuned for more practical insights into trading. See you in the next one.